Welcome to the Angel Broking live streaming event. I'm Mayuresh Joshi, VP Institution Angel Broking, your host for the day live from Bombay. I hope everybody is able to see me on video and hear me correctly as well. Please post your name and location in the chat window if you can see me properly and hear me properly as well. Now, the chat window will probably appear to the right hand side of the video screen that you're probably logged in into. To access that, you'll probably need to sign in by accessing the sign in button, and you will probably need to use your Gmail ID. I will now try and lay out the comprehensive agenda that we've probably lined out today, and then I'll try and attempt to answer a few questions, stroke anything to do with sectors that you probably might have some questions with. So the probable agenda for the day that we're looking at is the impact of the union budget, the fine print, the top five sectors, and the top five stocks within those sectors. Clearly, again, I think the kind of impact earnings are probably going to have on specific sectors and probably the range of the markets or where the Nifty probably is heading over the next few quarters. So I think I'll start off with what the Exchequer or the finance minister presented in the union budget. According to us, probably it was a very pragmatic effort conducted by the finance minister, and he probably tried to embed into the union budget a mix of both growth-oriented policies as well as what the markets were probably expecting, some amount of uptick in the capital expenditure side. Now, the finance minister has been greatly aided by the fall in crude prices, and that has probably been seen in the kind of non-planned expenditure cuts that one looks from subsidies going down by 9%, and this will probably have a rub-off effect in terms of the capital expenditure outlay, specifically on the non-planned expenditure side, which has increased by 16.3% to be precise, at 1,06,000 crores. On the planning side, probably the revenue expenditure is expected to go down. The capital expenditure, again, on the revenue side is expected to remain robust, expected to grow by more than 34% at 1,35,000 crores. Now, if I look at the kind of budgetary program or the gross borrowing program that the government is intending to do for this fiscal year, it is more or less in line with estimates for the last fiscal year. So on the gross side, 6 lakh crores, and on the net side, almost 4,80,000 crores, which is at par with what last year's figures were. Having said that, probably I think a lot of measures were probably announced by the government and in the right directions too. So though he's given the fiscal consolidation roadmap and targets at 3.9% for the coming fiscal, I think that's a very pragmatic and a practical way of looking at things. And looking at the new GDP series, he's probably expecting a 15% growth in tax revenues. Having said that, probably the kind of impact his budgetary speech and his budgetary allocations are going to have in different sectors is what I'm going to discuss next. So when I talk specifically about automobiles, nothing great has probably come out of the budget. Again, I think the rollback of excise duties, which the finance ministry probably conducted in January, was a foregone exercise, and a lot of market participants are already factoring that in. So nothing great has come for the auto sector, but clearly I think one needs to be looking at these stocks very, very carefully, because with the kind of base effect that we had and the lowering of MSPs, I think that will definitely have some amount of demand on the rural discretionary spending. We will come back later and talk about this sector and the stocks possibly that one can look at with a long-term perspective. When you're talking about capital goods, clearly I think the allocation has been quite robust towards this sector. And if I look at it constructively, and if I try to put through certain announcements that he's even done probably on the infrastructure side, I think it seems pretty reasonable. So I think the kind of rural development expenses laid out at around 79,000 crores, I think that will augur well going forward as well. And even on the urban development side, he's probably looking at figures in excess of 10,000 crores. When you're looking at five power plants being put of 4,000 megawatts plug and play, I think that is going to be hugely value accretive for a lot of these BTG generators. So one really needs to be stock specific again, because I think one really needs to see how the orders will flow, what kind of execution issues a lot of these companies are facing, and clearly the working capital constraints that the entire industry has to contend with. The defense outlay has increased by 15% or to 94,500 crores. And that probably has got reflected because the kind of enthusiasm that one was probably seeing even before the budget, with FDI probably coming through for the sector, I think a lot of these stocks have reacted substantially. So take, for instance, the case of Bharat Electronics, BML. To a certain extent, I think these stocks have run up. So I think one really needs to be looking at how the numbers will pan out, assuming order flows remain robust for this entire space. Again, in terms of cement as a sector, 2 crore urban houses expected to be built, 4 crore rural houses expected to be built under the government for program and agenda of housing for all by 2022. So that definitely augurs well for these companies. The rural outlay that I'm speaking and the urban outlay that I'm probably talking about will ensure that probably the demand comes back in the infrastructure space itself, and that should affect cement volumes going forward. The volume growth along with demand recovery will ensure that the utilization levels of most of these cement companies probably start inching up, which will definitely reflect positively on their return ratios. So I will discuss a little bit more on the cement sector going forward as well, and our probable picks within that space itself. Now, clearly, I think no great announcements were expected to come through for the IT and the pharma sector. But clearly, I think a lot of expectations was that MAT and DDT would go to get reduced to a certain extent. But that probably did not happen. Though the finance minister probably has done some amount of leeway when it comes to the foreign institutional investors with deferment of GAR. And clearly, the kind of impetus that he's probably given for offshore fund managers, that could live up to the expectations that a lot of FIIs and FDIs had from the budget space itself. Clearly, the outlay towards railways at 40 odd thousand crores augurs well for the entire sector as well. And we've seen a lot of stocks probably react in terms of anticipation of what Mr. Prabhu had presented a couple of days back. But clearly, I think higher allocation towards that, and again, I think a couple of these cities being built at Chendre and Dholera, I think the EPC contracts worth 1,200 crores being awarded. Even that is a positive sentiment for a lot of EPC players. Towards the road development side, I think 33,000 odd crores are being allocated as a capital outlay to lay out around a lakh of kilometers of roads probably expected to come through over the next few years. So that definitely augurs well for a lot of these road developers. But one really needs to understand what the kind of viability gap funding that one probably expects from the government to probably come through. With a lot of devolution that is probably expected to go to the states, a lot of state contribution will start coming in, and the buying will probably happen with states and earning a substantial amount of the revenue pie from the central government. And again, I think the implementation of GST will have far-fetching effects for a lot of companies, specifically the FMCG logistics space, which clearly will benefit from implementation, which is expected in April 1st, 2017. So clearly, I think the budget has been quite pragmatic in our view, and our take is probably the markets at this juncture when we are specifically talking as on date. A lot of events have got factored in, so I think the budget is out of the way. Clearly, I think the surprise RBI rate cut that one witnessed in the intermittent period did have a surprise element for a lot of banking stocks. The deferment in terms of rate hikes by the Federal Reserves have also got gestated into the markets. So if I talk into a holistic perspective, I think when all these things are probably over, what are the markets probably looking at? You're witnessing a selling pressure coming onto the markets on a daily basis. But clearly, I think if one takes a judicious long-term structural view, I think India is placed in a very sweet spot. Corporate earnings need to revive for entire re-rating of the structural improvement of the markets to happen. And that might be the weakest link when it comes to the recovery of the markets from a short to medium term perspective. Corporate earnings have been quite tepid in the quarter gone by. And if one expects and if one assumes, I think you'll still see that the corporate earnings remaining weak for the better part of quarter four and quarter one as well. So I think if one assumes the government program to start contributing over the next couple of quarters, the capex cycle getting revived, investment cycle being revived, and government spending probably coming through as expected, one might also expect the private capex to start following up with the government spending, and that will definitely have a lot of impetus when it comes to corporate earnings improving. But clearly, I think a few key bills need to get passed. A couple of bills have already got passed. I think the insurance bill a few weeks back, the MMDR bill, the mining bill probably that got passed today. I think those are some positive elements that one is looking at. But structural reform processes, specifically on the land ordinance and various other bills, need to probably come through. And once they start showing and exhibiting results, I think corporate earnings will improve for the better. Along with that, I think structural rate cuts, if one assumes from the Reserve Bank of India, to the tune of 50 to 75 basis points and moderation in CPI, that are a few things that the markets will look going forward. So structurally, India is in a very good spot when it comes to the emerging space itself. Because if I do a simple comparison check with different emerging markets, we are better placed than a lot of our counterparts. China has its own sweet problems. Brazil has its own commodity-driven problems. Russia is facing similar issues, and the devaluation of the ruble is a clear indication of the fact. A lot of the Southeast Asian markets, including Thailand, Indonesia, are probably fairly valued. We're not expecting a huge amount of cut probably to come through from the markets, but if the earnings do disappoint in a substantial manner in Q4, and that indication has probably been given by a lot of IT companies, FMCG companies, where they've actually backed down on their trend going forward with a lot of cross-currency headwinds hitting IT companies, margins expected to come through. And again, I think the rural discretionary demand probably not meeting up with the kind of market expectations. I think that will have some amount of impact when it comes to the FMCG earnings. So clearly, I think markets, is in our opinion, probably staying in a range between 8,400 and 9,000. If there is some amount of negative bias in terms of global events with deflationary pressures and oil going down further from the current levels that we are witnessing, global demand will take time to probably come back. Again, I think IMF is very clear that global demand will take time, but probably India stands out. So in that space itself, I think there is every possible reason to believe that we might be stuck in this range for some length of time. But again, I think if one really has a stock-specific approach, I think one can make money over the next 12 to 15 months. And now try and address a few of the sectors as laid out in the agenda. So I think I'll talk about our top five sectors in the current market scenario and probability of top five stocks within each of these sectors. So if I come specifically on my first sector, the first sector that we like is the banking and financial space. Now, I think the banking and financial space holds a special place, not just in terms of the nifty constituents, in terms of their market share, but again, I think in terms of financial inclusion and India having a long way to go in terms of tapping not just the retail customers, but also I think a lot of corporates needing funding going forward. I think that will provide impetus for banking growth going forward. Through the tough economic situations that we just witnessed, our probable take is that credit growth should start reviving going forward. And with structural rate cuts coming around from the RBI over the next few quarters, our take is that the banking lending demand and growth should be quite substantial. Having said that, I think one really must differentiate between the private and the public space, which has been a debate and point of contention for some length of time. But our take is that one can actually look at the clutch of both of these stocks along with NBFCs. So what we probably like looking at results gone by and looking at future prospects going ahead is something like an Axis Bank, where we believe that the kind of numbers that they exhibited in Q3 were quite strong. Even if you look at the restructured pipeline and their asset quality, it has held up quite well. And in fact, it is expected to beat the restructured pipeline of 6,500 crores. And then the numbers can appear quite lesser than what they have predicted. Credit costs expected to remain benign, at least for Axis Bank, and the kind of capital advocacy that they have, I think the balance sheet expansion and growth can be quite significant. So the return on assets and the return on equity for Axis Bank can be huge going forward. So Axis Bank would be one of our preferred picks within the banking space. Follow that up with ICICI Bank, where the numbers had not been so great going forward, and one really expects the credit costs actually to inch up. But again, I think it's a stable bank. I think the management is quite strong. The branch network is pretty robust. And what all that indicates is that once the credit cycle probably revives and the rate cuts probably start happening, I think the asset quality pressures will lessen substantially for ICICI Bank. So the valuation of the private space is probably higher than the public sector counterpart. The balance sheet growth is also expected to be much quicker and faster, considering their nimble-footed management and the kind of branch network. So I think operating leverage benefits will play out for ICICI Bank. So that would be one of our preferred picks within the banking space. Within the smaller private space, I think Yes Bank is something that we have liked. We continue to like that. The recent budget also removed restrictions between FDI and FI distinction, and that would also abet banks like an Axis and a Yes Bank, where the foreign shareholding probably can inch up going forward. Again, Yes Bank with a strong liability profile, considering their capital adequacy, I think it is best placed to probably ride the economic cycle in a substantial way. So I think Yes Bank also remains one of our preferred picks from the private space. Coming to the public sector counterpart, State Bank has exhibited a strong set of numbers in the quarter gone by. And again, at 6.6% of the net stress loans, considering the balance sheet size, is a commendable task by SBI. The asset quality pressures that were expected to weigh on public sector banks has not weighed on our State Bank of India. And clearly, I think the bank is poised for good growth going forward. A very good CASA profile, and again, I think looking at the kind of FPO overhang that the markets perceive, our belief is that the 15,000 crores FPO, whenever it comes, will be value accretive. So State Bank probably at the current valuations also look pretty attractive. Follow that up with Bank of Baroda. I think Bank of Baroda did disappoint in terms of asset quality, but again, I think it's a robust network bank. I think the branch network is quite strong. Capital adequacy remains quite strong, and again, I think it will play out on operating leverage benefits once the economy cycle starts for better. So I think Bank of Baroda remains one of our preferred picks as well. Within the NBFC space, just to have additional stock from the banking and the financial space, LIC Housing is something that we continue to prefer and continue to like. Clearly, I think with rate cuts coming around the corner, the wholesale borrowing costs of LIC Housing Finance will go down in a substantial manner. The NII growth has been quite substantial in the quarter gone by, and the asset quality pressures have not played out on their balance sheet. So clearly, I think expecting good amount of retail advance growth, propping up the revenues for LIC Housing Finance, and valuations again not too stretched at this point of time. So LIC Housing probably remains one of our preferred picks at the current juncture. So I've covered the banking sector and the profitable stocks that we like. The next sector that I probably like to go out for is the auto and the auto ancillary sector. Now, clearly, it has been under some amount of pressure for the last few quarters and years, and the reasons were very obvious. In a weak economic environment, when the discretionary spend and demand is not that great, the auto stocks probably take a big hit because I think rate cycles were pretty much too high. And again, I think nobody was really sure of when the rate cycle might turn. But with expectations of the auto industry doing well, our take is that we need to be really selective about the auto sector. Clearly, because on two factors. A, I think the base effect was pretty huge. And B, I think specifically on the lower discretionary demand part, I think with the lowering of MSPs by the government, the discretionary spend will be a little bit muted over the next couple of quarters. But clearly, I think if one takes a stock-specific approach and a long-term approach, I think auto sector is well poised to ride the economic upturn that one might probably witness over the next couple of quarters. So what you probably like is something like a Maruti, who's a market leader probably in the entry segment and also the mid segment in the country. I think it still regains its market share as being one of the prominent PV and PV players in the country, and the earnings growth is expected to be in excess of 39%. Cash on the balance sheets, a lot of issues that once surrounded it are more or less over. So Maruti Suzuki is one stock that can probably be looked at. A couple of stocks that we probably like is Eicher Motors. Now, Eicher Motors has a unique business model where it is looking at two-wheeler from its Royal Enfield business, where the margins are quite high. There is a waiting period, but with the capex that it's probably done, I think the waiting period is expected to get down. They've added a lot of dealers, and the margins probably have sustained through a bad economic cycle as well. On the other hand, I think the CV business with Volvo, I think is expected to do well as well. In bad times, I think Eicher Motors did give good EBITDA margins even from the CV venture with Volvo. And if one expects the MHCV segment probably to turn around for the better, I think Eicher Motors is placed in a very sweet spot. So Eicher Motors is something that we continue to like. The third stock probably that we're looking at is Ashok Leyland. Now, Ashok Leyland is probably a play both in terms of the CV cycle recovery and the deep financial leverage play. By that, I think once the cycle probably turns for the better, Ashok Leyland's earnings will rebound the fastest. So MHCV say sales probably auguring well for them. LCV probably has been a laggard for Ashok Leyland, but with a lot of excise duty benefits expected to come from their Pantnagar plant. One really expects, I think, the volume growth to probably continue on a consolidated basis for Ashok Leyland. The discounts per vehicle expected to go down over the next few months, and clearly that will augur well for their earnings trajectory. So Ashok Leyland probably can also be looked at from the defense space, where a lot of orders probably are expected to come through, and Ashok Leyland can be a key beneficiary. The fourth stock probably would be Hero MotoCorp. And clearly, I think the cost optimization efforts that Hero MotoCorp is doing holds it in good stead. Looking at venturing into new export markets that will ensure that the export revenue is also built up. And again, I think if you look at the royalty coming out of their books, it's a straight addition of 400 crores onto their bottom line. Valuation wise, it's not too cheap, but it's not too expensive as well. So clearly, I think Hero MotoCorp can be looked at from a long-term perspective as well. I'd just like to chip in with the Nota ancillary stocks, and JK Tire is something that we probably like at this juncture. Again, I think tire stocks had been running up with the kind of fall that one saw with crude prices. And again, I think you saw a huge amount of volatility and profit booking at higher levels. Numbers probably again appearing to be mixed, but clearly if one goes by the trajectory, I'm not expecting RSS4 prices to move up substantially from the current levels, and with rebound in auto demand, both in terms from OEM as well as the replacement markets, the EBITDA margins are expected to sustain going forward. So JK Tires is something that also looks pretty interesting to us. Now, the third sector that I'll probably talk about would be a mix of capital goods, infrastructure. Now, what we probably like within this sector as a brief is that the kind of capital orders or the order inflows that you've seen have been pretty muted for the overall sector. And what this probably means is that the orders are not expected to grow up thick and fast. Basically because of the kind of weak macroeconomic conditions that you're still witnessing into the markets, which is reflected again by the IIP data. And B, probably, I think the kind of tendering activity, which is a key start for understanding probably the sector. I think the tendering activity has probably not picked up. So if one goes by the results, I think L&T also disappointed in the result gone by. Their engineering segment disappointed in terms of margins. The hydrocarbon segment reported negative margins. Similarly for BHEL, I think the performance has been quite dismal over the past few quarters. Execution issues, the order book probably going down, but a few orders probably received, propping up the stock price. And again, I think the margins probably not stabilizing at the current juncture. So one really needs to be a little bit careful when it comes to the cap good space. But again, I think one really cannot ignore Larsen & Toubro. I think it's a barometer for the Indian economy, various subsets within the company structure itself. But again, I think from a pure infrastructure stroke engineering play, I think L&T looks best placed. So the numbers have been a little bit disappointing, and the management again has cut its order guidance for the coming quarter. I think once the economy cycle revives, and again I think the whole theme is when it will revive, but over the next 2 quarters, once the cycle starts showing signs of improvement, L&T can be a key beneficiary in this entire upturn. Again, I think if you look at an SLT valuation, you're also looking at L&T Infotech, which is their ITR, you're looking at L&T Real Estate, and all these probably contribute significantly, and the management is also very focused on removing its non-core assets. So L&T definitely remains one of our preferred picks. BHEL probably not right now at this juncture, and clearly I think execution needs to improve for a sustained improvement in cash flows. The second stock that we probably like at this juncture is Crompton Greaves. With the news of demerger, probably the stock did hit an all-time high of 235 to 40. But clearly I think their power business is something that will show signs of improvement. The restructuring exercise in the overseas business is gaining traction, and again I think stabilizing. So the Hungarian business, the US business, the Canadian business is showing signs of stability, and you're seeing some amount of good order traction probably coming through. So Crompton Greaves is something that we like from a 12-month perspective. As well. What we're also liking probably from the infra space is a stock called FBL Infra on declines, and clearly I think the company is into the EPC space. As I was mentioning, 1,200 crores probably earmarked for the Shindra and the Dhulera project. So that should probably also ensure that the 10,000 crores of orders that FBL Infra is probably bidded for, and the track record of 25% order wins would ensure that the order book remains quite robust for FBL Infra. Four of its BOT projects are expected to come on stream over the next few quarters. So that is probably expected to ensure that the cash flows sustain. So MBL Infra probably on declines also looks like a very interesting bet. Again, I think Blue Star is something that we are liking in terms of a value pick. Its EMP division, which is package and electromechanical projects division, is expected to perform well. Though I think traditionally the winter season is probably one of the weakest quarters for the company, but the management is probably very, very confident of delivering top line and bottom line growth in excess of what the industry estimates are believed to be. The room cooling solutions probably are doing quite well as well, and doing a comparative channel check with dealers. Our take is that Blue Star looks pretty attractive, both in terms of an earnings outlook and also on their valuation. So Blue Star is something that long-term investors can also look at and consider on declines. Now, the fourth sector that I'll probably like to pay attention to is cement. Now, it's been a highly debated sector over the past few years, cartelization issues surrounding the whole sector. And again, I think the kind of capex plans that a lot of these players did over the past few years obviously had an impact on their balance sheets, because with weak demand, the utilization levels were probably at low levels, even below 70%. And that probably ensure that their ROEs don't improve. But with an improving demand environment, and when one probably expects that volume growth is expected to go up, that will probably have some amount of impetus in terms of their utilization levels going up. And clearly that will reflect onto their return on earnings and return on capital employed. Now, the probability of a lot of these stocks have already done well. But again, I think for the cement space, the kind of infrastructure spend that one probably expects, not just from the kind of housing improvement that the government is probably looking at, with 2 crore urban houses, 4 crore rural houses, 6 crore toilets expected to be built, a lot of infrastructure projects, the freight corridors, and so on and so forth. That will have some amount of positive rub-off effect onto these companies. So something like a Mangalam Cement from the mid-cap cement pack looks pretty attractive. On an EV to ton basis, trades at around $45, which is quite cheap on its installed capacity. And the numbers have been quite robust. So the realizations have remained stable, the raw material costs have remained benign, which will ensure raw material and which will ensure EBITDA margin expansion for the company. So Mangalam remains our preferred pick. JK Lakshmi Cement in the equal breadth, I think, looks quite interesting to us as well. So I think the kind of installed capacity that JK Lakshmi has got, the markets that it probably caters to. And again, I think the stable realizations that one probably is talking for the cement sector as a whole, that would hold JK Lakshmi Cement in good stead as well. Again, I think valuation is not too expensive at the current juncture, so one can have a look at JK Lakshmi Cement and declines as well. Among the large caps, what we probably like is an ECC and an Ultratech Cement as well. So I think both these stocks probably are expected to do well. Ultratech Cement, based on its installed capacity of around 60 MT, and again, the installed capacity expected to go up over the next 12 months to 70 MT with captive power. And again, I think the kind of expectations that one probably builds in, Ultratech can be expected to ride the cement cyclical story in a very, very meaningful fashion. Though on a valuation, this is probably one of the most expensive stocks, but our take is at around $195 EV to ton on FY17 basis. I think the stock looks pretty attractive for a long-term perspective. In similar breadth, probably ACC looks pretty attractive considering the same parameters. And again, I think the kind of expectations that one has specifically from ECC in terms of demand outlook and the kind of regions that it caters to, specifically the western parts of India, I think that will probably help it in good stead, considering the freight corridor movement that one expects both of the western and eastern corridors, where it is also trying to set up its plants. So clearly, ACC also remains one of our preferred pick. One of the dark horses probably within this cement space can be an India Cement. Though it is surrounded and mired with a lot of controversy related to its promoters and so on and so forth. I think the stock is reasonably valued, very cheaply valued at the current juncture. And our probable take is that the kind of developmental exercises that one is looking at Telangana region, and the majority of its plants are probably located within the same space itself in Andhra Pradesh and Tamil Nadu. I think a lot of development activities can rub off in terms of volume growth happening for India Cements. So India Cements can actually turn out to be a dark horse within this cement space. Now, probably within the defensive space, I would like to club two sectors together, IT and pharma. Both these sectors have shown robust earnings and the cash flows have remained pretty strong. So in bad times, probably people flock to these sectors. But even in volatile times like we're witnessing today, I think a lot of interest in terms of investor appetite probably going up to not chase risk stocks, but to go for stocks with a defensive outlay probably goes up. So I think I've selected a few stocks for both these spaces combined together. And what we like probably from the spaces is something like Infosys. Infosys did surprise in the quarter gone by, and with a new man at its helm, Sika is probably doing probably the right things. Again, in terms of what one probably expects with Infosys and the kind of guidance that it has probably given even so far, I think it's a little bit of a conservative opinion in our sense. So in that sense itself, I think Infosys from a valuation perspective, as well as expectations of customer discretionary demand probably going up in the US markets, I think it is best placed to ride that. Though a lot of IT companies might probably witness 200 to 250 points of headwinds from the cross currency impact, because a lot of the other currencies have probably depreciated, including the euro. I think that will have some amount of impact onto the EBITDA margins. But clearly, I think the NASSCOM estimate should be maintained. Our own take is that cross currency growth in revenue or in rupee terms probably should be in excess of 13.5%. In the same breath, I think TCS probably has outperformed, but probably has underperformed over the last few months. But clearly, going forward, I think with the kind of asset size and asset base that TCS has, the number of customers that it has got, and again, I think the kind of catering that it probably does within the BFSI space itself, I think TCS looks like a very interesting bet. Though on a valuation perspective, it probably has moved up a little bit. Long-term investors can definitely look at its stock on declines. I will turn my attention towards the pharma space, and pharma probably has done exceedingly well for the past few quarters, and going forward as well. Our take is that earnings momentum should probably continue. The kind of generic launches that one expects these companies to launch with the applications that they've done in the US markets. And even if one assumes a lot of these FDA issues probably cropping up for these pharma companies, they probably have built in a lot of these FDA issues coming up at some point of time. But the kind of earnings trajectory that one can probably look at from the US business and generally the European business as well in terms of tendering, I think that augurs well for these companies. So I think Sun Pharma is something that we are probably liking at this stage. And our probable take is that Sun Pharma is expected to show stable and a robust earnings growth. So Sun Pharma probably remains our preferred pick along with Dr. Reddy's purely based on valuations. The numbers probably of Dr. Reddy's would disappoint a lot of market analysts in terms of the EBITDA margins. But again, I think it's got a strong A&D application profile. Their R&D expenses probably have gone up. But once I think these expenses start accruing benefits in terms of product approvals, a lot of earnings momentum can be seen into the markets. So I think the pharma stocks are expected to do well. So I think Dishman Pharma is also something that we like within the mid-cap space. FY16 might exhibit a strong set of numbers. So I think I've covered most of the sectors. We also like a few mid-cap stocks just to blend in with a few large caps. So something like a Transport Corporation of India within the logistics space is what we are liking, more or less to do with their growth expected on the XPS and their inland logistics solutions. And that will probably offer their earnings well. Bajaj Electrical clearly looks like an earnings story and a turnaround story, but the results will be a little bit disappointing. I think with a 2-year perspective, the stock can turn around for the better. And something like Hindustan Media Ventures from the print media space is I think strong balance sheet, market leader in most Hindi reading belts like Jharkhand, Bihar, Uttarakhand, and that company will reflect good earnings momentum. So I think I've covered most of the stocks that we are probably looking at, most of the sectors we are looking at. And now I'll try to comprehensively answer and attend a few of the investor queries. We'll start answering that in a couple of minutes. Questions begin at Okay, now I'll try and attempt to address a few of your queries that I'm now seeing on my chat window. Now, particularly user has a query on uh, Tata Steel. And again, I think if one probably looks at the business cycles that Tata Steel has probably gone through, you're probably looking at good numbers probably coming surprisingly from the EBITDA per ton basis on European operations is $64. But the domestic operations, both in terms of volume growth, will depend on the expansion in the Kalinganagar plant. And clearly, I think once this volume expansion happens, I think the steel realizations will depend on what kind of recovery A one sees in the Chinese market in terms of demand supply, and B our own local domestic demand supply probably going up. So I think it will get balanced off with the kind of raw material prices that have gone down as well. Iron ore has probably gone down, coking coal has gone down. So I think that will probably ensure that the EBITDA margins for Tata Steel are maintained going forward. The recent approval that is today of the MMRD bill, that probably minerals and mining bill, that will probably have some amount of issues when it comes to the royalty payments. But clearly, I think if one has a couple of years time horizon, Tata Steel, if you've bought the stock at lower levels, clearly hold on to it. Okay, and now I think Tata Motors DVR is one stock that has probably moved up substantially from the lower levels. I think we had recommended the stock at lower levels, and our premise basically was that the discount differential that the stock had with Tata Motors should come down. And it was a simple mechanism that we probably followed. We just followed a few of the international stocks, and their ADRs or GDRs did not trade at a discount to what Tata Motors was with Tata Motors DVR. So clearly, I think it is A, dependent on what kind of operational performance Tata Motors probably does. And B, clearly, I think the discount gap has come down substantially at the current level. So I think at the current level, from fresh investment perspective, I will wait for substantial declines, probably the discount differential to increase. And there are probably some amount of issues in terms of JLR margins probably remaining at the current level. So from a fair value perspective, we are very close to what the target price for Tata Motors is. So I think the preference for if one really needs to buy into Tata Motors DVR, one really needs to wait for a substantial decline happening onto this stock. So clearly, I think as I mentioned from my initial anecdote, I think JK Tires is something that we continue to like. Yes, I think the debt levels are pretty high for JK Tire. But if one probably looks at the trajectory going forward and the improvement both in terms of OEM and replacement demand coming through, JK Tire can be a key beneficiary. I think with sustained cash flows and if one probably expects crude to remain in a range, I think the raw material costs are not going to increase substantially for JK Tires or generally for the tire companies. So clearly, I think the OEM replacement demand coming back in a substantial manner will augur well for JK Tires. Our target price for the stock stands at 145. Now, if one really has a long-term objective into the markets, I think one must clearly understand uh, that the market probably moves in cycles. Now, if you're looking at the structural story for India, as I've mentioned before, one really needs to be keeping a view of at least a couple of years. So, if you have a couple of years view, I think you can create a structure of portfolio in a staggered manner over the next 2 to 3 months. And the logic behind 2 to 3 months is that the earnings growth is not expected to grow or revive so soon. So the earnings might probably disappoint a lot of market analysts, and that would be the probable and the right time to probably enter the stocks when it corrects substantially. So on any significant dips that you see, qualitative stocks that we've discussed probably today on the show, I think would be a good entry point. Create a sustained portfolio with a staggered approach and hold on to these stocks for a couple of years. I think you'll make a good amount of return on investment on your holdings. Yes, I think there is some amount of consolidation expected in the banking space itself. And as I mentioned before, I think a lot of these stocks probably have run up in the anticipation of either rate cuts coming through thick and fast or the earnings momentum increasing. But again, I think the macro environment picture, as I mentioned, the credit growth still in single digits. I think for that to improve will take some amount of time. Again, I think the kind of asset quality pressures that one is probably seeing on the public sector enterprise part, I think that will still continue for the next couple of quarters. What it probably means is if one is probably looking at the stocks, you have already mentioned that before. I think Axis, ICICI, Yes Bank, State Bank, and even if I throw in an NBFC, LIC housing looks pretty attractive. Oh yes, I think I did discuss uh, the FMCG space generally at large, and probably I think I have no recommendations from the space at least on now. I think the valuations have probably moved up in a substantial manner, and though I think quarter four numbers might be a mixed bag, I think a lot of the crude oil benefits and the falling raw material prices would reflect on the EBITDA margins of these companies. Having said that, I think a lot would depend on the kind of volume growth these companies exhibit. And that would be an interesting aspect to see in these results to come. Because clearly, I think rural discretionary demand with lower MSPs are expected to be on the lower side. So one really needs to see how the FMCG volume growth actually pans out. And again, if it pans out for the better, I think it has to be sustained. So I think good monsoons will ensure that kharif production remains strong. And if that probably remains strong, the discretionary demand, at least in lieu of absence of higher MSP prices, is expected to go up. So I think being very selective on FMCG is warranted at this point of time. What the budget probably has done, to answer your question specifically on ITC, it has increased the excise duty substantially, 25% for cigarettes below 64 and 15% otherwise. So I think there will be a clear volume degrowth happening. One does not probably expect that to come through in Q4, but Q1 will see a huge volume degrowth. However, I think ITC will pass on these prices, which will ensure that the top line is maintained. So I think if you are planning to have a fresh investment, probably wait for results in ITC. If you're already holding on to the stock, hold on to the stock, because I think the kind of pass through that happens in terms of cost probably gets reflected. And the other businesses are expected to do well for ITC, FMCG, paper business, agri business are all expected to do well over the next few quarters. Though their pie in bottom line is probably not as large as the cigarette business, but their pie will slowly and steadily increase. And clearly, again, I think valuations support ITC specifically for the FMCG pack comparison as well. Okay, now gas authority of India typically is having a few issues on its own. Now, if I look at the gross block addition that gas authority has done and the kind of profits that it probably throws out, I think the investments are probably stuck up for Gale. And obviously, I think if you have noted, I think the underutilization of its pipeline, the Bangalore pipeline, the Kochi Bangalore pipeline, I think that underutilization is probably hampering the prospects of Gale. Now, with higher prices, probably I think you're probably looking at a lot of the positives that Gale probably has been built into the stock. So a lot of the long-term contracts that Gale has probably built in with Gas of Qatar and a few of the US companies probably have got built in. So I think the stock might underperform for the next 2 to 3 quarters. Though I think subsidy sharing probably is ruled out. Still, probably the earnings might not be that robust. So I think if I'm talking about the oil and gas space in general, I think further clarity probably required in terms of ONGC, in terms of subsidy sharing. So I think the government probably needs to come out with a concrete formula if one really expects oil to remain at these levels. And again, I think one really expects the government fuel subsidy to go down substantially from last year's fiscal. So I think clarity required. Once clarity probably emerges, one can probably look at ONGC and oil. Because I think the earnings can be quite substantial if there is a sustained formula. But clearly within this space, from a long-term perspective, Reliance Industries of declines is what we like. It has probably remained range bound. It is expected to remain range bound because a lot of its capex plans in its core business are expected to come on stream in FY17. And a lot of its non-core capex that it has done, I think that will start accruing benefits from FY18 onwards. So if you're banking on the core business itself, I think those earnings momentum will start happening after FY17, which is a year and a half time from now, and that is ensured that the ROEs have remained subdued for RIL. But again, I think attractive levels, because once the improvement probably happens, and again, quarter four expected to be extremely robust for RIL. I think the GRMs can be extremely good. The petchem business is expected to do well. So RIL probably remains one of our preferred picks, because the horizon, as I said, has to be from an FY70, which is a couple of years perspective. But yes, I think again within the NBFC space, I've already mentioned LIC Housing to be one of my preferred picks. Robust asset quality, the credit book looks pretty strong. Expected to grow the NI book pretty strongly as well. And again, I think valuation is not too expensive. So LIC Housing can be looked at within the NBFC space. Spark has moved up quite substantially and for rightful reasons. But again, I think in terms of valuations at the current juncture, if one can go long in Spark, probably I think one really needs to wait. So within the pharma space itself, I think I like its parent more. Sun Pharma probably has all the right ingredients to ride the markets in the right direction over the next couple of years. Robust earnings, management is quite strong. Even if one assumes its merger with Ranbaxy, I think the ROEs will still be one of the strongest in the business. Good cash positions onto its books, which will ensure probably that the earnings momentum in terms of valuations sustain for Sun Pharma. So I think at the current juncture, it will be a no for Spark, but yes, Sun Pharma obviously would be a better bet. I've mentioned a lot of stocks. In fact, I've mentioned around 15 stocks around various sectors. So I think if you're probably looking at a long-term perspective, 2, 3 stocks, I think within banking, Axis, Yes Bank looks very attractive. Within auto, probably an Eicher Motors is expected to do well. Within the pharma space, something like a Sun Pharma, as I was just mentioning. If you're probably looking at a value pick and a turnaround story, you're probably looking at a stock like a Bajaj Electrical, which we believe can show a turnaround in the coming 2 years. Yes, within the mid-cap pharma space, probably Dishman is what we continue to like. The earnings probably might be a little bit volatile in Q4. So I think if one really needs to take a call, wait for the quarter four numbers for Dishman Pharma. If the stock probably retraces or corrects back, because I think our own expectations were close to 24% EBITDA margins for the quarter gone by. They did disappoint, but a lot of bunching up of commercial orders will probably come through in the first half of the coming fiscal. So I think that will augur well, because that will ensure that the margins are sustained at a 24-25% mark. So Dishman again on valuations at 8 times forward looks pretty attractive. So that remains our preferred mid-cap pharma pick. So clearly UPL, I think with the current acquisition that it probably did in Brazil, I think it gives a foothold into the Brazilian markets on a stronger note for UPL. The current Brazilian operations account for 2.5%. The Brazilian market itself is $11.5 billion market. And probably that will increase its presence not just within the LATAM geographies itself, but I think that will also augur well for the balance sheet growth. So UPL is something that we've been consistently recommending for a length of time. It is very close to our fair value when it comes to FY16 numbers, but once the quarter four numbers come, we might roll over the targets to FY17. The business model is robust. The earnings trajectory seem very, very strong as well. And again, I think looking at the backward integrated program that they've done worldwide, acquisitions and deployment spread across, I think the revenue streams can be expected to remain strong. So I think UPL is a very strong contender. We've still not rolled out our numbers, but probability is that the stock will continue to do well. So if you're holding on to UPL at lower levels, please continue holding on. So again, within the paint industry, what has typically happened is the fall in crude oil prices definitely rubs on to the stocks. I think EBITDA margin expansion becomes quite substantial. Now, if I talk specifically in terms of paint stocks, I think a lot of this could not get captured in Q3. But the expectation is a lot of this will get captured in Q4. So I think the EBITDA margin extension can be quite substantial. And again, I think one really needs to categorize within the paint sector itself what you're looking at. So I think within the decorative paint segment itself, I think Asian Paints is the market leader. The new plants that it probably put up, I think utilization levels should probably improve for Asian Paints, and similarly for other stocks as well. So I think it also caters to the automobile industry, and if one expects uptick to probably happen there as well on the industrial part of their business, is expected to grow. Valuations probably might be a concern. So I think we're probably neutral at this point of time on a lot of these paint companies. But again, I think if one really expects the earnings trajectory to go substantially, with that drastic improvement probably happening from the home improvement sector, which is the home sector, the decorative side of things, and the industrial side, which is the automotive side of things, I think valuations probably can get re-rated. So I think Asian Paints has outperformed. So if you're holding on to Asian Paints, please hold on. I'm sorry, I don't carry a view on Kansai Nerolac. So I think Asian Paints is something that I will probably say if you're holding on at lower levels, please hold on. So I'll probably take one last question and probably we'll wind up the session for today. So I think I'll take the last question within the energy space itself. And the question probably that is asked is Suzlon good at these levels? Again, I think Suzlon with the infusion of Mr. Sanghvi's coming in, I think that will create some amount of impact. But again, I think the kind of cash flow improvement that one probably looks at the stock, one really needs to look at balance sheet dynamics going forward. In the same breath, I think Inox Wind, which is coming up with an IPO, is something that we would recommend retail investors to subscribe. It is being offered at a 50 rupee discount at the price band. The order book is quite substantial. The sites acquired at 2,150 megawatts is quite huge. The sites under consideration at 1950 megawatts is quite substantial. On an EV to sales basis, trades at 3.3 times, which is really attractive to us. And again, I think the kind of outlay that the government has put in of increasing the renewable energy output specifically on the wind energy part to 60,000 megawatts, I think that will all well. So I think Suzlon, not at this point of time, but Inox Wind subscription to the IPO, definitely yes. So thank you, friends. I think thank you for giving me a very patient hearing. Hope to have more of these sessions soon. Sorry I could not answer on all your questions, but I'll definitely have a look at these questions once I get the transcript. Probably your name and location and your email address is something that you probably need to leave behind so that I can answer these questions on your personal IDs and hope to see you soon. Thank you very much.